Okay, let's talk about it. Now, interest rates. Let's dive into that topic really quickly. And we all know Federal Reserve 0.75% just this morning, Malaysian time. What about it, man? 0.75%. Do you think it is out of predictions, or is this like not a surprise anymore? Go ahead, Mr. Sani.
Yeah, no surprise when we look at basically the what the future markets were predicting. There was basically a 2/3 chance, or roughly about 60 over percent probability of a 75 basis point hike, and that was the majority probability for this meeting. So that came out as expected. So no surprise there in terms of what was delivered. And I think that is why the markets basically didn't really move on the actual announcement of the 75 basis point hike. If you look at it, I think the market actually moved during the press conference, if I'm not wrong, when some of the things that Jerome Powell said kind of gave it a boost, and that's when really people, or rather one side of the market, thought that hey, this is really dovish, and everything just took off from there. So it was a very interesting press conference, because reading into Twitter, reading into some of the comments today, you can see a very, very distinct demarcation between half the room saying Jerome Powell was extremely hawkish, and half the room saying no, he was extremely dovish. And we're listening to the same press conference by the same person. Yeah.
No, this is what I want to talk about with you. I think this is the interesting thing that a lot of people will debate about, because yesterday I was also talking to our Patreon members. It's like we were just speculating what's going to happen. Is the Federal Reserve going to go with 0.75% or 1%? Because at the end of the day, this is what will drive the markets in the short term, right? Mm-hmm. And my question is, now, in the case of interest rates, right, it really just seems like a guessing game, right? It's like a probability game where, hey, I just shoot a dart into the board and see whether which is going to get 2/3 I'm going to hit this spot, 2/3 I'm going to hit the other spot. So is there another way around this? It just doesn't seem, if you take a look at a guessing game, play this guessing game, I don't think at the end of the day it's really fun.
Well, people in the market, they will look into what we call implied rates. You derive implied rates from a few places. You can derive them from your yield curve, you can derive them from your options, you can derive them. The main one typically is the CME futures markets, euro dollar markets and such, where you can actually derive, and there's actually a particular one which you can derive the actual, not say actual, but the implied Fed fund rates. So as I mentioned earlier, the implied rates for this meeting was 60% probability that will be 75 basis point, and that's what we got. And the implied rate, I'll give you what the implied rate is at present. And this morning when I sent out a note to my clients, this is what these were the implied rates at that point. I'm not sure whether they changed over the course of 12 hours, but the next meeting, there is a 70% probability of a 50 basis point hike. November, a 63% probability of a 25 basis point hike, and in December, a 50% probability of a 25 basis point hike. Okay, so what we're seeing the market now pricing in, after this double 7575, the remaining 3 FOMCs, 50 basis point, 25 basis point, 25 basis point, which would take the Fed fund rates to the range of 3.25 to 3.5. So that's what the future markets are suggesting will happen. But I then have to qualify it, because the future markets change. And I give you an example. A month ago probably, it was basically we're going to have 75, and this was basically before this particular two meetings. This particular meeting, we're going to have 75, 25, 25, 25 in the last 4 meetings of the year. Then it actually changed to last two meetings now. Basically, last 2 meetings, 25, 20. One more time. a week before, it was 75, 75, 25, 25 to take it to 3.5 to 3.75. That means at the end of the year, we will see Fed fund rates ending at 3.5 or 3.75. Now, the expectation is Fed fund rates will end at 3.25 and 3.5, which means that overall, the market is expecting the so-called end-of-year rate for Fed funds to be 25 basis points lower than they thought just 2-3 weeks ago. So it's a moving thing. People will build in expectation to these kind of implied rates. And that's what we're seeing today. So currently, as it stands, 3.25, 3.5 end of the year. 50, 25, 25, next 3 meetings.
So it's actually in accordance to what they previously portrayed, because previously they also kind of indicated that they're going to end the year with about 3.25 or 3.5 interest rate in total.
There is another thing that the Fed. Okay, so the market is one thing. The market will give its view via the futures implied Fed fund rates. The Fed itself comes up with so-called a dot plot, where each Fed member will give their forecast in terms of what they expect rates to be. And that's if you've seen it before, it's this graph with a lot of dots on it. And then they will take the average, and that's the suggested Fed fund rates based on Federal Reserve Committee members' expectation. What we're seeing now is we're seeing the Federal Reserve dot plot being significantly higher than that of the market. So it tells us basically that the market is pricing in the Federal Reserve being much more accommodative, much faster. It's suggesting that, hey, Federal Reserve, you may be thinking that rates are going to be higher, but we think you're going to pivot much faster than you think you're going to do so. So that's what we're seeing at this particular point.
Yeah, that's really a good one, Mr. Sani. But allow me to just dive back into the basic and maybe just allow majority of the audience here just to connect with us. How do interest rates at the end of the day affect the economy? Because maybe some people are still wondering, say, hey, what are we talking about? This interest rates raising 0.75%, 1%. Why are you guys talking so much technical stuff? But in a very, I would say, simple sense, Mr. Sani, how would you explain interest rates into the effect of the economy?
Okay, first and foremost, I think we need to understand what the Federal Reserve's mandate is basically to keep prices stable and to try and have what we call full employment. And that's it. They're not mandated to keep the stock market up. They're not mandated to keep the economy growing at 8 whatever percentage point. Their focus is basically to keep prices stable and basically to keep the economy at full employment. At their disposal, they have the control over short-term interest rates, not long-term, but only short-term interest rates. Okay, and of course, recently they added the ability to print. But anyway, let's just focus on interest rates. So by controlling short-term interest rates, effectively, when you move interest rates up and down, you are doing a few things. Primarily, you are impacting what we call aggregate demand, because after all, everything is based on rates. I increase rates, your your housing loan become more expensive, your car loans become more expensive, whatever business loans become more expensive. So that will then impact what we call, in terms of the overall economy, the consumption side and the so-called business investment side. Okay, interest rates also impact currencies in a certain manner, but then the Federal Reserve, I don't think is worried about that. It's more targeted towards if you look at the GDP equation, C plus I plus G, X minus M is the C and I, the consumption and the investment part. So by controlling rates, they actually control to a large extent aggregate demand in a particular economy itself, whether to entice you to spend more, leverage more, or to spend less and deleverage because it's just too expensive. So that's really the basic thing behind it.
Yeah, and at the end of the day, if there's a higher interest rate, we spend less and we start to hopefully save more, which is the Federal Reserve ultimate goal of bringing inflation down at the end of the day. That's why they really want to.
Yes.
Yeah.
I think you brought up a good point. part of the price stability is also to ensure that that real interest rates are positive. So real interest rates basically it's nominal interest rates minus inflation. So if you have typically your bank rate, say for example your bank rate's at 4%, but if your inflation is at 10, you have a minus 6% real interest rates, because inflation is basically way above your nominal rates. So one of the key determinants of whether a central bank is successful is basically whether it can keep real interest rates in positive territory. Because otherwise, people like pensioners, savers, and such, they get penalized when real interest rates are negative, because your purchasing power is just being eroded. Whatever you save just can't grow as fast as inflation. So that's key. And when we look at real interest rates in the US and many other developed countries especially, they're largely in negative territory, because most of the G7 central banks have prior to this adopted very low interest rate policies, very low, and as a result of high inflation, most of them are suffering from negative real rates. So they're trying to catch up to push it above. We don't think that the market doesn't think that the Federal Reserve will need to raise rates all the way to 9% to get real interest rates, because inflation is definitely going to come off. Let's say inflation comes back down to 5, then basically the Federal Reserve nominal rates should go to maybe 3, 3.5, 4. Try and narrow down that real interest rate. You don't really have to go above. I think just a small little negative real interest rate is still okay. You can still accommodate that, but definitely not 500, 600 basis point negative interest rate. That is just it hits their credibility a lot.
Yeah. Also really a good point mentioned there. I mean, at the end of the day, no one wants to pay money to store money in the bank, right?
Yeah, exactly. You don't see it because you store money in the bank, it grows at 2%, and then your prices of goods grow at 7%. You're effectively losing purchasing power.
No, this part is very interesting, because a lot of people don't see this. At the end of the day, they just see that, oh, my bank account is still the same balance every day, but in fact, it's depreciating every single second, right? And if the real interest rates are negative, it's essentially just draining away money from your bank account. You just don't see it, right?
Correct.
So it's really a mind-bending issue that I think a lot of people don't really understand about. But stay on topic right here. Bitcoin hiked by 8%, right? To FOMC press conference. I think when Jerome Powell said something, which I'm not so sure, you probably need to tell the audience what specifically Jerome Powell said. Stock markets in the US also rallied. Probably Bitcoin followed the stock market rally. So what are the key takeaways from the FOMC press conference at 2:30 a.m. this morning?
Okay.
Yeah.
I think
no way we wake up at 2 a.m. to go and listen, right?
Yeah, no, I was there. No, rather I was listening to it. So anyway, the reason when I started off the space session earlier on, I said the market was really right down the middle between the press conference being hawkish and dovish. And the reason is this. Verbally, the Fed was very hawkish. I mean, Jerome Powell said restoring price stability is paramount. There isn't an option to fail. When you say something like that, it shows that the Fed is not going to. It's focused on getting itself above inflation, at least inflation under its control, and not allow it to run away. Then the Fed said we don't think that the economy is in recession. And when you put these two things together, what you have is you have a Fed who is determined to clamp down on inflation, and a Fed which doesn't believe that the economy is in a recession. So therefore, when it raises rates to combat inflation, it doesn't have to worry about killing the economy because it doesn't think the economy is in a recession anyway. So that tells you basically that they will go all out, no hands tied to stamp out this inflationary fire, so to say. So that's the hawkish side of it, which people have been focusing on. Say, look, very clear, verbally mentioned. It was clear for everybody to hear in the room. This is what they mentioned. Yeah. The dovish side of it, i.e., those people expect rates to come off, they will then point to the statement where the Fed said, okay, from now on, we are not going to guide the markets by giving forward guidance. What we're going to do is we'll become more so-called data dependent. meaning to say that as the data comes in, we will make our decision. We won't adopt this forward guidance. Forward guidance was adopted basically because they didn't want the market to guess too much. Like you were saying, like what's going to happen? Is it going to go up? Is it going to go down? And that causes some uncertainty in financial markets. So forward guidance is the central bank will give hints, will give guidance to this is what we anticipate we will be doing, so that you can price it in, so that when it happens you're not surprised. But now, given the uncertainty with respect to a lot of situations and a lot of variables and such, they're saying no. What we'll do is, as the data comes in, we will react accordingly. Okay, so when you then look and the market says, wow, okay, in that case, when we look at the data, and say we means the market, when we look at the data, it's telling us that two things are going to happen. Inflation is going to come off, because commodity prices have come off, the global economy is slowing, and number two, the global economy itself, it's actually on a downhill because Europe is going down, China is slowing down, Asia, emerging markets are slowing down, even the US, as numbers have just come out, is also slowing down. So when we have inflation coming off and we have the global economy, including the US, coming off, we think, and we again the market, we think that the Federal Reserve, when the data comes in front of you and right in front of your lands on your table, you will start to either pivot, stop increasing rates, or even start to cut rates. So that sentence, we will be more data dependent, is what the dovish people then brings out to say, aha, despite the fact that the Federal Reserve sounded very hawkish, because they said this, and because we expect both inflation and the globally GDP to decline, it's sooner rather than later that they will actually pivot and reduce interest rates. So that reduction in interest rate is basically what sent the risky assets all higher. Because as we all know, risky assets got hit very badly in the first half of the year when rates were going higher. One of the reasons is when rates go up, when you start doing things like discounting cash flow, trying to value a company, higher interest rates causes lower valuation, and so on and so forth. Right? A bit technical, but at the end of the day, the Fed U-turning is going to do the opposite of what the Fed hiking did in the first half of the year, which is when they hike, all the risky assets fell sharply, and so therefore, if expectation is that they're going to U-turn and start reducing rates, then naturally risky assets will start to rally, and that's what we saw on the Nasdaq. That's what we saw in Bitcoin. So it's that expectation that the Fed is going to probably pivot sooner rather than later, and more importantly, they've opened the door to accepting data as the guiding decision to guide their decision. The market is like, well, it's a matter of time. The data will show that you will have to reverse course.
Yeah, perfectly said, Mr. Sani. Allow me to just unpack a few points you mentioned. Just basically, what the Federal Reserve mentioned is that they'll be more data-driven, right? And they will look at how the market is trying to react, and at the end of the day, then only they will put forward their policy. And markets are right now pricing in the future inflation that it might come down. Okay, because we are seeing globally right now, probably we're going to enter into a recession. There are a lot of indicators pointing towards a recession. And you also mentioned that the Federal Reserve pivoting, which in a very simple term, it means a U-turn, where previously they were really aggressive at hiking rates, like the earlier part of the year, from 0.25%, they went to 0.5%, then now 0.75%. Then those hawkish people, those people who think that the Fed will be more aggressive, was predicting 1% rate hikes. But they were ultimately disappointed today by a 0.75% rate hike. So those dovish people, they were like extremely happy. But let's focus on the ultimate point here. Okay, is the bear market over? Is this too early to call that the bear market is over? Because if we look at it in a more logical sense, and tying back to what you said just now, inflation is coming down. Yes, okay. Inflation is definitely going to come down. You see commodity prices not rising as quickly anymore or whatsoever. Oil prices has kind of stabilized, also dropped back down to below, last check, $100 per barrel. And the market outlook, at the surface wise, it looks kind of bullish right now. But is it too early to call for a bull run?
Okay. if you were to stop time now, okay, stop the hands of time moving now, then yes, it is actually the best time to buy. It's bullish. So what I'm trying to say is basically what we're dealing with now is we're dealing with a global economy which is gradually declining in growth. Okay, very clearly we have the World Bank saying that the chief economist of the World Bank saying that she feels it's going to be extremely difficult to avoid a global recession. Okay, we have the IMF saying we can't rule out the possibility of a global recession. And these are institutions which I believe over the years have proven that they pick their words very carefully, given where they are standing in the world. They don't mince their word, or rather they won't say anything which they think will rattle the market unless it's really something which they feel very strongly about. So when they say they think the global recession is coming or potentially could be coming, again, I have to underline the word could be coming, they're already sounding a warning across the bow. When we look at basically leading indicators from the OECD and such, everything is really pointing to being a synchronized downturn in the global cycle. Okay, so the fact of the matter is we have global economies slowing. So the big question now is, if it turns out to be a mild recession, then we may have hit the bottom recently, or we may just go down a little bit more from the current bottom and extend it basically by another 5%, maybe. Okay? But if that recession turns out to be moderate, don't be surprised if we then start going down maybe another 15-20%. Because again, I think markets have now rallied back to maybe, I think the S&P is maybe down 15 year to date, so on. In a typical recession, you will find that basically the financial markets, or the financial equity markets, go down roughly about 30 odd percent. Okay, if the recession becomes quite nasty, leads to what we call a crisis, and that is also potentially a scenario, then basically you will find a 50% top to bottom decline, because the 50% decline is what we saw in 2000 and 2008, okay, which will work out to be about 35% from here on the S&P 500. So what I'm trying to say is, I think the direction is there, i.e. global economies are slowing. The question on whether the market bottoms or not depends on where this recession takes us, mild, moderate, or deep. And the problem is now we don't know. Or we know the direction is slowing. We just don't know where it's going to make that U-turn. So we can attach probabilities to it, and therefore we can say that we think it's 50% chance of it being a moderate recession, 10% chance of it being a crisis, 20% chance of it being a mild recession, and so on and so forth. So that's what we can do. So I hope I answer your question, because it's really a question of how bad things. And some people will say, well, doesn't the market price all of this in? We know there's going to be a recession, but the pushback to this kind of question is, how do we know whether it's going to be a mild, moderate, or deep recession? Because as we go along, things start to crop up. As we go along, then we will start knowing, defaults are cropping up. We can make assumptions now to come up with some of these probabilities, but as we go along, we will see defaults. We will see liquidity squeezes here and there, causing companies to find it very difficult to find dollars, and so on and so forth. So if the Fed can't even model inflation, which is one variable, imagine trying to model a global growth where it will U-turn when we have multiple variables involved, hundreds of variables involved. It's almost impossible. And some of these things you don't know when they will crop up and how, and the degree to which they will crop up. I mean, if Russia switches off gas to Europe tomorrow, then scenario number 3, i.e., a violent recession is on the cards, and so on and so forth. So it's something which I think, as an investor, we need to be very careful, not to just say that it looks as though, it feels as though it's bullish, because we have passed, in my view, the first 2 risks early this year, which is basically an interest rate and valuation risk. We had a shock when the Federal Reserve and many central banks started to hike rates so aggressively, and that shock was made its way through the system. We had a shock when many financial markets started to adjust lower because they've been going up so much over the past couple of years. So these 2 shocks, interest rate and valuation shocks, were the ones that caused what we saw in the first half of the year: the decline in bond markets, the decline in stock markets, the decline in cryptocurrencies, and so on. What we haven't seen is the repercussion of those shocks, because those shocks will make its way into the real economy, i.e., hike in interest rates will have maybe a 2 or 3 quarter lag before it starts showing up in the real economy, and such aggressive hikes have often caused sharp recessions or recessions. The Fed has this track record of the past 13 times they've hiked rates aggressively. 10 times is led to a recession. There's only 3 times which they've managed to maneuver what we call a soft landing. So historically, they've not done very well, in other words. So the consequences of what was done in the first half, destruction of wealth from valuation shock, massive increase in interest rates, which is going to make its way into the global economies by the second half of this year. So the big question now is, how bad will those consequences be in the second half? So in the second half, if you look at it, we've yet to see the so-called default shocks. We've yet to see the liquidity squeeze shocks, and a few others which may crop up as a consequence of what we went through in the first half.
Yeah, again, great points mentioned there, Mr. Sani. And again, let me just summarize what you just said. We're in the eye of the storm, like what we've covered previously in our previous session, which for you guys in the audience, if you guys haven't listened to it, head on over to our Spotify tomorrow morning or something like that. When you're driving to work, I think it's the perfect time to listen to our previous sessions. Yeah, basically we're in the eye of the storm, right, where everything seems calm. And you mentioned the first half, when the Federal Reserve raised interest rates really aggressively, the economy faced a huge shock, right? And then right now, money is being withdrawn, money is being quantitative tightening, okay? And the second half of the shock right there, the aftershock that we might be feeling, is the liquidity shocks, the default from loans. We are still not feeling the brunt of it yet, and looking at it, we might be veering towards that path. So in a more simpler example, like it's kind of like you're in the dark, you walk towards a sinkhole, you don't know whether it's 5 meters deep or 100 meters deep, or maybe you'll show up at the other end of the earth or something like that, So essentially, when we try to talk about how bad the next recession is upcoming, or maybe we are in one already, this is why we kind of say there's still a lot of uncertainties left in the market, right, Mr. Sani? It's not so easy to go and call like, hey, right now the crypto market is trying to price in the future, everything seems fine, let's just buy from here. But it's not as simple as it is at the end of the day. And yeah. You got something to say, Mr. Sani? You can go ahead.
Yeah. So you're right. So if you want to get into markets, basically you have to have a strategy, and you really have to be cognizant of your risk reward. I hear a lot of people who are going into the crypto market, especially to buy Bitcoin, for example. So their rationale is basically at 20,000. I feel that at most Bitcoin would probably fall, let's say, even if it goes into 4 digits, 8,000, 5,000. So from 20,000 to 5,000, that's a $15,000 downside. But if I hold this thing long enough, I think it's going to go to 100,000, which is from 20,000 to 100,000. That's 80,000 upside. So I'm comparing a 15,000 downside to an 80,000 upside, and you can work the ratios out there. I think that's fine. I think if you understand that, and you have you understand the time frame that you're holding, you understand the risk reward that you're taking. If it then goes below 8, I'm going to cut 8,000 or 5,000, I'm going to cut loss, and I'm going to take that loss. Well, it was a so-called trade, and my trade was, I expect losses to be limited to 5. Didn't work out, so fine. So people who do this, I take my hats off. I think that you understand what is needed when you take such bets. It's the people who think that, it's the bottom now and let's get in now. So and we'll make our money when it goes back up to 100,000, and yet they don't take into account the downside, because it can still go down. So again, I'm just trying to say, for some people who realize and understand this concept of risk reward, maybe put in a stop loss, and even if I don't put in a stop loss, I can just hang on to it jolly well for the next 10 years if I wanted to. I'm fine holding it at 20 because I know it's eventually going to go to 100, 200, 300,000. I think it's then a market which, if you want to go in now, fine. I don't see an issue with it. It's those who I think may not understand this concept, which sometimes get burnt and get hurt in these kind of markets.
Yeah, but at the end of the day, it is eventually going to go back to whatever price point you're looking at, And previously, you've also analyzed and compared Bitcoin's market cap with gold. You previously mentioned this before, that you believe that Bitcoin will approach gold's market cap also, which, as long as investors have a more long-term perspective, buying at any point of time, it doesn't really matter. If you have a 5 to 10 year horizon, and considering the denominator, which is fiat currency, is debasing at a minimum of 5 to 10% per year, especially this year we can see maybe it's 15-20% already, then eventually Bitcoin will reach to whatever price point you want, as long as you have the patience to wait for it to go to that price point. Are we right to say this, Mr. Sani?
Yes, you are right. I just only have to qualify that basically we could be wrong, because there's nothing that's 100%. So as long as you understand that maybe one day doesn't turn out to be the case, we have strong arguments that Bitcoin will go up to 500,000 per coin, because that's where it matches go in terms of market cap. Everything is fine, but again, there's always that 1% it doesn't turn out. So if you understand that 1% means you're going to lose whatever you put in, or rather you're going to lose that stop. When you get triggered on your stop, you're going to lose that amount. I think that's fine. So that's really what I was trying to say. So it you can have the strongest argument, and I believe very, very much that what you just mentioned, all these things, but at the same time, you have that kind of at the back of your head, okay, if it doesn't work out, then basically this is where I limit my losses, or this is where I say, okay, that's enough and such.
Yeah, which is ultimately why you don't bet the whole farm. Don't put your whole life savings or whatever into a particular cryptocurrency or a shitcoin, or maybe even Bitcoin, right? Just make sure to spread your eggs in multiple baskets. But let me just move into another topic right here. Yeah, let's talk a bit about recession. Just now we mentioned this also. The Federal Reserve says we're not in a recession, Well, from what I heard at the press conference, what Jerome Powell said is our labor market is still very strong, employment rate is still very high, I don't believe we're in a recession, and I don't think the United States will enter a recession. Is what he says, is it true, or what? What are we looking at here, Mr. Sani?
Well, there's some truth to it. There's half truth to it. Because typical recessions would encompass, and the National Bureau of Economic Research or Statistics, the so-called Stats Department in the US, which calls for this so-called, they will be the one who will put a stamp on when recessions, where are the recession periods. I think they have a much broader definition than the pure technical to negative quarter-on-quarter negative growth and such. So their definition is you need to have not only the decline in output, you need to also have a decline in employment. And when you see all of this, then we would actually call it a recession. Otherwise, it's just it's weird to call for a recession when you have employment at full, when you have the economy at full employment.
Sorry, Mr. Sani. Let me just cut you there for a while. But employment and labor market right here, all these are lagging indicators, which means that they show up later when the recession has already happened. Then only employment rate starts to drop. So essentially, by the time you wait for employment rate to drop, it's already deep into a recession already. So is there any way for an indicator to predict way ahead that we are going to enter into a recession?
So it's a technical thing, and that is why the NBER, which actually determines when the US is in a recession, they only make these recession calls later on. We may be in a recession today, but it's just that 2 quarters from now, they will then, when all the data comes in, and maybe next few months the employment rate declines, then they'll say, okay, it fits the definition of recession, and they'll come back and they'll draw this gray period and say, oh, this was a recessionary period. So recessions are always called with hindsight, and for the fact that you mentioned, because many of the indicators, a bunch of the indicators are lagging indicators. Okay, so those indicators that are telling us that there is a recession today are what we call either the forward-looking indicators or sometimes what we call the coincidental indicators. Indicators which, at this particular point, when you look at it, the University of Michigan Confidence Index, which is published on a monthly basis, you look at, it's at historical lows. Basically every time it hits below a certain number, it does suggest a recession. So everything indicates that basically we are in a recession based on this particular indicator. There are a whole bunch of indicators which are telling us it's a recession. We are already in a recession because historically when you reach these XYZ levels, it ought to be a recession. So that's how economists and strategists like us kind of get a feel that, hey, it is looking to be like we're in a recession because these indicators are telling us. But officially, from a technical basis, it still needs to be called later on by the NBR, who will come back and say, yeah, this period was or this period wasn't. It's just that one of the indicators that they use, which is employment, doesn't seem to fall in line, although there are already hints that this is going to come off. Because when you look at employment, you could make an argument that we are actually in a very, very unique situation. Not one which is very normal in many respects. I mean, I don't think in history we've had a situation where there's a reopening of the economy. Okay, so basically there's a rehiring because now that the economy has reopened, everybody got either retrenched during the lockdowns and such. Companies are now rehiring because economic activity is picking up. And yet we had a period where there was a big retirement or we call it a great retirement, where people opted to retire early or move out from the workforce because they felt that life is short. And COVID has told me that has woken me up to reality that it shouldn't be all work, And then we had a whole segment of workers leave the labor force because they felt that they wanted to do something else. And add those two things together, now you have this, and to make things to add one more thing into the soup pot, is that the markets were doing so well last year. A lot of people actually were making tons of money in crypto and the stock market. They actually left and said that I made enough money to retire and such. So you add all of this together, you got an economy which is now opening and looking for workers, and you have a whole bunch of workers who left and are not coming back. Yeah, maybe they are sooner or later when they start realizing that I've lost a lot of money in the stock market. But at this point, there's a mismatch between supply and demand so it's a unique situation, and that is why demand for labor is so high. But it doesn't. The figures don't tell it, or the figures basically just say employment is high, unemployment is low. Yeah. So that's the unique situation we are in. I don't know whether the Fed takes that into account. I don't think so, because otherwise they would have reacted accordingly. But that's the reality of it.
Definitely not lah. I think definitely the Federal Reserve didn't take that into account. In fact, this is the first time since COVID came out that they never mentioned anything about COVID in the entire session, which was just really surprising to me. Now, you guys in the audience can go and listen to the replay of the Jerome Powell Federal Reserve press conference. Just go and search that on YouTube. It's an hour session. Highly recommend you guys to listen to it, though it's a bit boring, but a lot of information shared there. But the point where they don't even mention about COVID at all, this really surprises me, because to add more stuff into your quote-unquote soup pot over here, COVID cases are rising again, Mr. Sani. Yeah, let's face it.
So,
The United States,
yeah,
150,000 cases per day, last I checked. Malaysia, 3,000-4,000 cases per day. And China is recording about 7 to 1,000 cases per day, if I'm not mistaken. What to add on more is we have a new monkeypox, we call it. It can be a potential outbreak also. So at the end of the day, if you jumble all these things together, right, it seems like I think the Federal Reserve is really at a tight spot right now.
True.
Yeah.
Yeah.
So okay, now that we've settled the Federal Reserve part already, we know that the Federal Reserve is going to be a bit more dovish in the future. The September rate hikes are going to be coming down to about 0.5%, but that ultimately depends on the inflation data, right? So if inflation data, let's say it comes out red hot, then obviously we're going to expect the Federal Reserve to turn back on whatever dovishness they said and immediately hike rates more aggressively, right?
Correct. That would be the worst case scenario in my view.
Exactly. Is there a
because
possibility? Is there a possibility for us to see that?
No one expects CPI to stay, at least the rate of growth, year-on-year numbers to stay high. Everybody anticipates, given the base effect, given what we've seen on commodity prices, for year-on-year CPI to start tapering off 9, 8, 7, 6, maybe even 5 and such. Can it stay high? That's the black swan here. And the answer is yes. When you ask people who are dealing with physical demand, not just paper instruments on the various commodities like maybe even copper and oil. I mean, oil has come off, but when you look into some Twitter feeds where people are on the ground talking about physical demand, they'll tell you that physical demand is still tight. And a few other industrial commodities also is still tight on the physical side. So some of this decline in commodity prices were basically on the back of hedge funds selling, long positions unwinding because an anticipation of a recession and such. So nothing to do with, not say nothing, but very little to do with actual supply and demand, more to do with the market side of it. If that's the case, basically that means that we could see prices remain elevated throughout the next couple of months and not come down. I've always said that basically it's not enough to have 5% CPI or whatever PPI year on year. It's not even enough to have 0% year on year, because oil prices at 100 today, oil prices at 100 next year is 0% year on year growth. Looks nice, 0%, but oil prices remains at 100. So nominal price remaining at 100, it's very difficult for economies, households, to businesses to absorb and to operate at $100 oil prices, despite the fact that there hasn't been a growth in the price of that oil for 1 year. So that's the major risk. And one black swan coming out from the left field is we're still not out of the woods in terms of the energy crisis with respect to Russia and Europe and such. All it takes is one disruption somewhere to then reignite inflation again. Just imagine if Russia's kind of like just maybe not switch off totally, or they already started to reduce some of the gas going through the pipelines now, but because of that, European manufacturers or European supply chains become disrupted. What happens? Because the world is so integrated now that a disruption in the European supply chain will then permeate through to Asia and the rest of the world, which then again leads to higher prices because we got a disruption in supply chains. So I don't profess to be an expert, but I've been reading about people who say that these things are so fragile that we shouldn't take it for granted, because one small kink, one small disruption easily could have a butterfly effect and cause prices to move up again unexpectedly. So yes, it could be a case where all of a sudden CPI comes down and suddenly starts moving up again because we have one of these issues cropping up, and that would be disastrous because the market hasn't discounted that.
Hello, Mr. Sani. Can you hear me?
I can hear you. All of a sudden, quiet.
Sorry. Because I accidentally clicked on the voice transformer thing. Is this a new Twitter feature? Wow. I'm not going to explore this just yet. I was wondering what's happening with my Twitter. But yeah, again, thanks for your points covered over there. It's really too early to call for the bull run right now. There's still too much uncertainty out there. But yeah, Mr. Sani, Sing dollar and Malaysian ringgit. Mr. Sani, you are a Malaysian, but you are working at Singapore. Wow. I got nothing to say, but you're enjoying the high life, basically, because Sing dollar right now is at 3.2. Oh, it's at its all-time high against the Malaysian ringgit. It's even strengthening against the US dollar, the Sing dollar. So what's going on here, Mr. Sani? Can we just talk a bit about this?
Okay, so when we talk about currencies, we always talk about a pair of currencies. In this particular case, you're talking about Sing against ringgit or Sing against US. Okay, and how they interact determines where your currency goes. So meaning to say, if it could be Sing strengthening, ringgit weakening, it could be Sing strengthening, ringgit strengthening at the same time, but not as much as Sing, and you still see basically the Sing ringgit going up. So it's an interaction of these two currencies which determine eventually the level of the exchange rate. Okay. Right now, what's very, very clear is that the Sing dollar is on a strengthening path. And how can I be so certain that it's on a strengthening path? Well, it's because the Monetary Authority of Singapore is one of the very few countries in the world which does not use interest rate as its monetary policy tool. Instead, it uses the Sing dollar, a basket value of Sing dollar, as its monetary policy tool. Meaning to say, whenever it feels that there are inflationary pressures like currently today, it will strengthen the Sing dollar. It will guide the Sing dollar on a basket basis, but you can always view it from the Sing dollar being strong against US dollar and the rest of the currencies. It will consciously guide the Sing dollar to be on a stronger path. Why? Because Singapore basically imports the majority of things it needs. It's a small island. You've all been here before. You know that we don't have our own chicken and so on and so forth. So we need to import everything from Malaysia and the rest of the world. When you import, basically, when you have a strong dollar, Sing dollar, you import cheaper. So meaning to say you do not import inflation, or you reduce the inflationary importation of inflation because you have a strong local currency. So that's the idea behind managing the Sing dollar as a monetary tool instead of managing local domestic interest rates. Okay, so in this particular case, the MAS has been very aggressive. Again, nothing different from other central banks. Other central banks raise rates. The MAS says we will strengthen the Sing dollar. So this is the effect that you're seeing now, i.e. the Sing dollar is actually gaining strength against almost all currencies, and so on. So now Sing ringgit. Okay. Then you have to bring in the ringgit side of it. Is the ringgit strong or is the ringgit weak? Okay. From my look at the ringgit, and I think I put it out on a tweet before. The ringgit is actually relatively strong. The ringgit is weak against the dollar, but so is a whole bunch of other currencies. They are weak against the dollar because the Federal Reserve has high interest rates so high and so fast that the interest rates in the US currently today swamp interest rates everywhere else in the world, causing what we call a very wide interest rate differential, which is supporting in favor of the US dollar. So US dollar is strong against everybody. So that's the point. Why do I say that the ringgit is actually quite strong? Because when you place the ringgit against the baht, against non-commodity currencies like the Filipino peso, even the euro, you will find that basically the ringgit has strengthened. When you place the ringgit against commodity countries or commodity currencies like Australian dollar, Indonesian rupiah, you'll find that it's trading sideways because both commodity currencies have strengthened at the same time. So it's when the ringgit is compared to a non-commodity currency that the ringgit has strengthened. So why do commodity currencies strengthen? Well, because if you are a commodity exporting country, you export palm oil, you export oil and such, you then receive foreign exchange. Okay, and basically that strengthens your balance of payment. Your current account then switches over to becoming a surplus, and that actually strengthens your balance of payment, and that actually results in a stronger local currency itself. Okay, so bring all this back to the Sing Ringgit. I think what we're seeing is we're seeing the ringgit actually strengthen, but we're seeing the Sing dollar strengthen more than the ringgit. Going forward, what potentially could we be seeing? Potentially, I think the path is clear because I think the Sing dollar will remain on a strengthening path, but I kind of worry that the ringgit may actually lose some of its strength because we are seeing commodity prices come off. So some of the weakness today we're seeing maybe is related to some of the decline in palm oil, some oil prices and such. So if you ask me, I think we've not seen the top in terms of Sing Ringgit. We could potentially be moving higher on that. That also brings me back to the dollar itself. One thing that I'm very worried about is this strengthening dollar. And if you remember, I spoke earlier about what the market's pricing in, another at least 100 basis points to the end of the year. That will bring so-called dollar interest rate differential to be way higher than other countries. I mean, just imagine the US dollar now going 100 basis points higher to the end of the year. I don't think Bank Negara, for example, is going to raise rates another 100 basis points. I don't think the Europeans are going to raise rates another 100 basis points, which means that differential is going to widen, which means that the dollar will be strengthening against most other currencies. What worries me is a lot of emerging market corporations have actually borrowed in dollars over the past couple of years quite aggressively, with so-called the need to make coupon payments in dollars, the need to make maturity payments in dollars, lump sum maturity payments. We could be facing a situation where there could be a dollar squeeze, and we are already seeing some signs of that. The initial signs, nothing serious at this point. Not only here in our part of the world, but also in Europe. Again, following some people who follow this closely on Twitter, they're really saying there are some signs of dollar shortages here and there. Okay, so that's something I'm looking at in the second half of the year, which is again tied to what we call a liquidity shock, where we could actually have some situations where companies and corporations and even sovereigns may find it difficult to get their hands on certain currencies, especially the dollar.
Yeah, I think you pretty much answered Ryan's question over here. I pinned it up on the space also. He was asking about whether Malaysian Ringgit will strengthen against the US dollar in the near term or not. Well, the answer is no lah. We are sorry to clip your wings, Ryan. Oops. Not because we're not patriotic Malaysian. Just about the tying back to what you said also, right? Let me just unpack. It's about the interest rate differential, right? It's seeing which countries raise interest rates the fastest. And right now, the Federal Reserve is raising interest rates so quickly that Bank Negara is not even willing to catch up. China is actually lowering their interest rates, if I'm not mistaken. The EU, they are not even raising their interest rates yet, which is why you see the European currency dropping to almost on parity, like a stable coin to the US dollar at some point of time. Right?
I have to interject here. They did hike the other day 50 basis points, but from minus 50 to this bring back to zero lah.
Yeah. So eventually it's not so it's not really a stable coin anymore. Now it's a bit above the US dollar. But then again, they're still extremely slow in terms of the rate hikes compared to the Federal Reserve. And we are seeing this pattern emerge throughout the whole world, which is why the US dollar right now is so strong. But here's another argument, Mr. Sani. Okay, that Malaysians always use. Malaysia is an export country. Okay, so if the US dollar is strong, since Malaysia exports a lot of goods, it should be good for a weaker Malaysian ringgit, right? Oil prices, with it being like almost $100 per barrel right now, and with the government subsidizing 50% of oil prices, then it's not so good, isn't it? Because right now, the government, apart from needing to pay more in terms of rising oil prices, they need to pay much more also in terms of their currency, the Malaysian ringgit weakening, right? So it's kind of like a double-edged sword, right?
Yeah. So I think you're absolutely right. So there is a level where many emerging markets will tolerate, and this is different for different countries, will tolerate a weakness in their currencies, because if they're geared towards export, then that is actually a plus. Okay, but that's not just the only variable involved in this whole equation, because they have to also think about, number one, what about capital that's in my, especially short-term capital that's in my capital markets. Weaker ringgit will cause losses for foreigners who have invested. Will they go out? If they go out, then it's actually pressure on my currency, a reverse flow, so to say. Number two, again, do I import most of the stuff that I have in my country? Again, that brings in inflation domestically from externally, and so on and so forth. So yes, correct from the perspective, if we're talking about just earning $1 from a barrel, selling, or $80 from selling a barrel of oil and then converting it to more ringgit, therefore revenues are higher. Totally agree. But it's a little bit more complex, I guess, and it's different from country to country.
Yeah, I think, Mr. Sani, you also know about this, but Malaysia's oil is highly subsidized by the government, when it comes to fuel prices. Allow me to just approve Haikal up. Hi, Haikal. Wait, just give me 1 second to approve you. Yeah.
Just a few things to comment. Since we are actually talking about ringgit right now, right? So what Mr. Sani highlighted is exactly the dilemma we are facing, because we are somewhat like Singapore, where we actually import our inflation, which is felt by the populace, the people basically. Like for example, if you notice our latest CPI numbers, it's at 3.4%. But when you look at the breakdowns, the devil, right? Most of the higher ones are actually on food, which is actually imported. So you see, there's a dilemma here between you want to take care of corporates, because Malaysian corporates actually profit when ringgit depreciates. Their ringgit depreciate and their external assets also grow in ringgit terms. But when it boils down to consumers, right, you're basically killing their purchasing power, because part of our inflation is also actually imported, like Singapore. So in a way, it's like what should we do right now? Which is why during the last session, if you recall me saying that we need to improve our food supply chain and whatever, because the problem is the very things that drive our inflation, on the ground inflation, which people actually feel, is imported, like Singapore. But at the same time, we are also like, if we go on the Singapore route, if we actually intervene in the FX market, you're actually going to shrink your corporate's external assets, because our external assets are larger than our external liabilities. So if we go and strengthen ringgit, our corporate assets will shrink down, external assets will shrink down. So we're like, what should we do? So that's one thing So when you're making policies, you're actually okay. So that's the one thing. The second thing is, like Mr. Sani also mentioned, it's true that Sing dollars policy is interesting, where they actually target exchange rates. And you can actually confirm this by seeing that Singapore's monthly foreign reserves have been falling, because I guess because Sing dollar has been strengthening, so they must have also intervened a bit to keep Sing dollar strong. So that's also another proof that actually Mas is propping up their currency lah. And again, as I mentioned earlier, we do not know what to do. So we are just letting markets decide where ringgit goes lah at this stage. And of course, I cannot say anything about where it will go because that's not my job anyway to speculate on ringgit. But that's the situation going on from a central banker's point of view lah. And also another thing, earlier Mr. Sani mentioned that one of the black swan events is about Russia closing the pipeline to Europe. Now there's another black swan event that is much more localized and much more relevant for us Malaysians, which is China-Taiwan relations. That's an even bigger black swan event because as you know, China has been facing some issues internally with their economy slowing down, and also at the same time, the CCP has been quite hawkish on the Taiwan issue, and of course, the United States being the whatever you call it, being the tukang cucuk, with Nancy Pelosi intending to go to Taiwan to whatever reasons to secure the chip, to understand the supply side of the chips or whatever issue, whatever she has in her mind actually will probably make the situation more complicated than it seems lah. So that's also another black swan event, which if it happens, we do not know yet what will happen, what it means to the economy. So that's also another black swan event to think about lah. So those are the three things that I wanted to add on lah, basically.
Yeah, well, very good. Thank you, Haikal. I think as usual, you always give a very good perspective because you are a central banker yourself. So it adds a lot of color to some of the things I say lah. I was expecting you to say when you said European has its own black swan, Malaysia also has its own black swan. I thought you were going to say kita punya black swan is the blackout that we often have baru-baru ni.
That surprised me tau, because I suddenly my friend, Bank Negara blackout tak? And I was like, blackout? Why? There's blackout tau. And I was like, oh really? And then just received the news, a lot of places in Malaysia blackout. What's happening, man?
This election coming up? Is it?
Not sure.
Yeah. But I think overall, just touching on Malaysia and talking about black swans and such, I think one thing that, and we were talking earlier on, Shinji, about the oil subsidies and such, I think it really, really has come to a point where, and I think the government has put in some effort in this sense, but it's really come to a point where fiscal austerity, or trying to save up for a rainy day, has to take precedence. And what I'm trying to say is basically this: we have a good opportunity to earn oil revenue because oil prices are very high, but a lot of the oil revenue goes to pay off the subsidies, which means that net we're not utilizing the gains from higher oil prices. Unlike the Norwegians, which have grown their so-called sovereign wealth fund to more than $1 trillion, our sovereign wealth fund, Malaysia's sovereign wealth fund, if we want to consider Kwan as a sovereign wealth fund, or rather, not sovereign wealth fund, but rather oil stabilization fund, is still, I think, in the billions of ringgit, probably $1 billion and such, compared to 1 trillion. Because at the end of the day, looking into the future, oil will eventually run out, and when that happens, you need another mechanism to support the budget. And in the case of Norway, once you build up your stabilization fund to about $1 trillion, you earn basically 3-4% on as investment gains. Those gains can be used to supplement your budget every year. So what you lose out in terms of oil revenue in your budget, you basically replace it with investment gains. And that's the same thing with Singapore, which has grown its reserves massively. There's an allocation of, I think, there's a rule here where current government can use about 50% of whatever they make, and then they need to save another 50% and such. So many countries in the world have started to grow their so-called reserves, domestic reserves or stabilization funds. These are not foreign reserves that's got to do with Bank Negara, so that these reserves eventually will help to supplement the fiscal budget that every year the government needs to find money to run the country. And so I think something has to be done while oil prices are still high. Because if we waste this opportunity and oil prices start to come down once the production starts coming in, and so on and so forth, we now then oil prices start trading back at $40 per barrel for the longest time, and eventually goes all the way down to 20 because solar comes in, green energy comes in, and eventually will come in. We've really lost an opportunity now.
Yeah. Back to the point where to just really unpack what you just said again, subsidies is basically what's keeping our inflation from spiraling out of control right now. Yeah. And just take a look at when you guys go to the gas station and fill petrol into your car. Look at the difference between the yellow color one and the green color one, okay? RON 95 and RON 97. And you will understand which one is subsidized and which one is at the market price right now. And the government this year alone has spent over $80 billion just to subsidize oil and other stuff. So essentially, I don't know how long this will last, but the government is trying to remove their subsidies right now, which triggered a massive protest last week, so-called the Turun protest. And they are proposing to do targeted subsidies. Now, we will debate on whether targeted subsidies will work or not, but there's a question from the audience right here. I got a DM. Can you comment more on the new global reserve currency? How will it impact us? Wow, this is an interesting one. The new multipolar currency, so-called BRICS, BRICS, partnered with Brazil, Russia, India, China, and South Africa. What's happening here, Mr. Sani? And will we see the de-dollarization begin?
Well, the de-dollarization has already begun. Although not in any quick manner prior to this. There were instances where trade took place. I think, in fact, Malaysia was paying for its mixed aircrafts in palm oil, right? So not in dollars. So here and there we had prior to this. But what really accelerated this de-dollarization recently has been, I think, the Russian sanctions couple of years, which started not now, but a couple of years ago, but just strengthened recently because of the war of Ukraine. China also has become quite edgy because it holds a lot of US treasuries and such. So countries which are not aligned to the US and to the Western world have come to realize that in this time and age, it's quite easy for a superpower like the US to just cut off dollar supply, or even make it very difficult for them to convert, if they have dollars, to convert it to use. I mean, they've eventually taken Russian banks off SWIFT and so on. So the next best alternative, of course, is to then go and create your own trading blocks where you start trading in your own currencies. Meaning to say, if I'm China, you're India, China's going to buy goods in Indian rupees, and India's going to buy goods in Chinese yuan and stuff like that. So you kind of sidestep the dollar, and of course you can create your own block currency, so to say, and everybody then trades using that currency itself. So and then again you sidestep the dollar because you're not using the dollar anymore. Okay, so that's happening, but it's really a slow motion. Not say slow motion. It's gathering pace. But I don't think we will see it like become the reserve currency of the world overnight or in a very short term. You need to do a few things in order to dethrone the dollar from where it's currently sitting. Among these things is, number one, you need to bring down the dollar dependence in world trade. A lot of world trade is being settled in dollars. I think at least 40-50% or more is settled in dollars. And as long as people settle in dollars, means they demand dollars. Okay, you need to bring down basically debt denominated in dollars, because a lot of emerging markets, especially emerging market sovereigns and also corporations, tend to issue bonds in dollars. It's more stable for them because their local currencies may be very volatile. And when you issue a bond in dollars, it means that you need dollars to pay both your coupons and you need dollars to pay the maturity of that bond, which is, again, equates to demand for dollars. You need to actually decouple oil from being paid in dollars, because otherwise every single barrel you want to buy, you need to go and source for dollars itself. So these three things itself basically results in a natural demand for dollars. And as long as that demand remains, then of course it's very hard to dethrone the dollar from its throne or its place as king of all other currencies, i.e. a reserve currency itself. Having said that, I'm also beginning to hear about how the de-dollarization is actually gaining pace. So what I would say is basically, I think it will happen in my lifetime, although I'm quite worried, but it will happen in my lifetime, and not something which I think is the next 50, 60 years. So we could see within the next 20 years itself, or even 10 years, these kind of the de-dollarization actually take place very fast. Someone wrote something very interesting recently. Let me try and recall how to put this. The person said that as de-dollarization occurs and people start to settle in different currencies, so what will happen is the so-called central banks will then have a lot of multiple currencies in their reserves, and Haikal can allude to that. Today, the bulk of those currencies are in dollars, because trade is in dollars, debt is in dollars, oil is in dollars, and so on and so forth. Okay, so you recycle the US dollar into US treasuries, because you don't want to hold dollars, you want to put the dollars into an asset which may yield you a bit of return. So central banks basically hold their dollars in US treasuries, US bonds, and so on and so forth. Okay, but when you start to de-dollarize, you'll find that you don't have that many dollars. You have a lot of other, I would say funny currencies, but a lot of multiple types of currencies in your. So where do you put them? Where do you? I don't want to have so much rupees. I don't have so much Chinese yuan. I don't want to put them back into a rupee denominated bond, a yuan denominated bond, a rupiah denominated bond. They could be depreciation and so on and so forth. Although they may be government backed and such. So there's this one particular tweet which I kind of found quite interesting. He said, when we reach that point, the so-called asset, the reserve asset, could actually be gold. So central banks will then take gold as the settlement asset, as the asset which basically they fall back on to convert everything to put it into this particular asset, rather than expose themselves. I've got extra rupees. I'm going to put it back in RBI. Reserve Bank of India bonds, Government of India bonds, but I really don't want to hold Government of India bonds. What do I do? Where do I put it? Then I put it in gold. Okay, I know there are some Bitcoiners in the room. I will not rule out. Who knows? Maybe 10, 15, 20 years from now, Bitcoin could be a reserve asset from that perspective itself. Yeah. So again, this is just throwing up things which have just cropped up in this discussion with respect to de-dollarization.
Yeah. Haikal, about de-dollarization, any points to add? Please go ahead.
Yep. So I'm going to talk from the Malaysian perspective. So actually, if you realize, from Bank Negara, what we have been doing is we have this so-called local currency settlement framework. So for those companies in certain countries, like we currently have local currency settlement frameworks with Indonesia, Thailand, and China, among others lah. So now, instead of corporates having to pay in dollars, they can actually settle in their local currencies. For example, you can settle with Chinese companies in yuan, or Indonesian firms in rupiah, or Thai companies in baht. So that's one part of it. So yes, Bank Negara has been trying to not help companies to actually reduce their dependence on dollar lah. And if you notice, there's a question in Parliament where someone, I don't remember which member of Parliament was that. He actually asked what is the Malaysian government's action to actually reduce dependence on dollars. So LCSF lah is the answer. But of course, we are doing it gradually. We are not we are not as gung-ho as the Russians or the Chinese lah. Suddenly saying, okay, we want to do another reserve currency. But yeah, the pattern is there, even for Malaysia, and this is public info. This is not some secret info. It has been going on since 2010. And of course, it will be gradual from our perspective lah. And for if Mr. Sani noticed lah, yes, last year, we actually started linking Do It Now and Pay Now. So now Singaporeans can just scan and use Pay Now to actually directly transfer money to Malaysian businesses, people, and so forth lah. If you notice, so that's also another initiative from Bank Negara lah. Because we are in such close region. Why do we need to depend on the dollar? So it doesn't make any sense lah. Like the governor said during an interview, it's a no-brainer lah, basically. So that's from the Malaysian point of view.
So I heard about that, the Do It Now to Pay Now. I didn't know it was already in existence. So you mean that basically just using phone number, you can actually transfer money to me?
Yep. It started last year lah, so I wouldn't be surprised if you haven't heard of it yet. I think December or something macam tu. Quite new.
Okay. Then maybe later I'll just DM you my phone number. You can try it out. Send some ringgit to me. But how does it go? You send ringgit and it will be actually translated into Sing.
Yep. No more dollars. No more having to use USD.
No middleman.
No middleman. Yep.
Could the Malaysian ringgit go back to 4.2? It's currently trading at 4.45, 4.46. I don't think anybody anticipated such weakness for the ringgit against the US dollar, but can we go back to the 4.2 level or not? Let me just direct this question to the central banker. Haikal, what do you think? Ringgit dropping back to 4.2 levels?
As part of my work responsibility, I'm not allowed to say. I'm not allowed to give any figure. I cannot target any figure, or else I'm in trouble. So sorry, I cannot answer this question. I'll pass.
Wow. Okay. Mr. Sani, go ahead.
Oh, okay. So 4.2 was not too long ago lah. Last year we were at 4.2. Okay, so if you were to say why ringgit has weakened from 4.2 to 4.45, 4.5 now, we spoke about the interest rate differential with the US, right? So there's no saying that, and there's nothing to say that the US may actually not reverse course and start to reduce rates, as we mentioned earlier, pivoting early, and maybe if there's a deep recession, the Federal Reserve may actually cut rates much faster than people anticipate. And that's being built in currently for next year. It may accelerate. At the same time, local inflation here in Malaysia may actually be elevated. So Bank Negara may actually start keeping rates high and even nudging it higher in order to try and fight inflation. So in that particular case, we will have a narrowing differential. So with a narrowing differential, there's nothing to say that the ringgit may actually could not actually strengthen or wouldn't actually strengthen back to the 4.2 and even stronger than that.
Yeah, back to the basics lah. At the end of the day, the interest rates will catch up, to the Federal Reserve, and we will see the Malaysian ringgit strengthen against the US dollar again.
But if you really want to talk about the long term, I think that's short term is quite difficult to predict because you've got all these kind of different things. So long term, the ringgit's strength is very much dependent on what we call not only interest rate differential, that's very short term. It's actually dependent on what we call the balance of payment. How much money you attract into Malaysia in terms of foreign direct investments, in terms of what we call financial services flow or financial flows to your stock market, to your bond market, vis-a-vis the opposite outflows lah. Okay, and secondly is your exports minus your imports. So if you have very strong exports and you have very strong ability to attract FDIs and you have very strong ability to attract money into your capital markets, then naturally speaking, your ringgit should be on a strengthening path. So that's the thing which will cause the ringgit to remain strong long term, is to have these three things, or at least a few of these things quite solid lah, so to say.
Yeah, great points again, Mr. Sani. So Haikal, did the things you mentioned just now roughly correct or not? Boleh tak?
I mean, in the long run, yes lah, of course lah. And Malaysia's balance of payment, we have positive current account actually. So a lot of it we are seeing actually part of our depreciation is partly hot money, because if you look at our bond market holdings, right, our foreigners holdings of our government bonds have been shrinking to 20% from 20 is about 20 something, almost 30. I don't remember the exact figures. And also the stock market, we actually see foreign flow outflows. So foreign ownership in our equities have been dropping from 24 to 25 to now it's 2019, something like that. So that's also some of the reasons why ringgit has been depreciating lah. But the long-term holders are here to stay. And as Mr. Sani mentioned, long-term wise, which is also why the federal government, this is not what Bank Negara can do. We do not have the authority to do structural economic reforms. We can only advise them on what they should do, but ultimately it's up to them whether they want to do it or not. That will decide where ringgit will go lah. And one good thing that I want to highlight today, if you notice in our Parliament actually passed anti-hopping law. So no more kataks, which I think is good because it gives the impression that we will have a more stable political governance moving forward lah, which reduces not completely eliminate, but reduces the possibility of another Sheraton happening. So I think that will be a good catalyst for investors who are looking for political stability lah.
Yeah, not only foreign investors, but I think for the nation as a whole. The biggest problem with again, I'm Malaysian. I love my country, but there are issues with it, which I have to admit, is the fact that the politicians have never been long term enough in terms of their vision. It's always been to the next election. It's always, and with all this hopping around, it's even shorter than that. It's like, all effort has been focused on trying to gain majority by and getting people to hop and so on and so forth. So it's an excellent move, but at the same time, I think the vision has to be long term. Those long term visions have to be followed through. You cannot have visions changing every 4 years, every 5 years, every time the government changes, you have vision changing. You need to anchor those visions, and no matter which government comes in, those visions need to be followed through because they are good visions. So the big question is how to set those visions. Here where I am in Singapore, and again, we give credit where credit is due. They are very visionary. They will tell you this is the plan. This is what we're going to do for the next 20 years, and they do it, and they make people accountable for it. So and they every now and then they will bring into a group of people who are CEOs of big multinational companies, people who are so-called futurists who try and predict the future. They will put their own people in the room. You know that when a couple of years ago, Vitalik Buterin came to Singapore, and that was when Ethereum was really nothing, and he was giving a speech. Someone was telling me, in the front row were a few officers from the Monetary Authority of Singapore sitting down there taking notes, and this is when Ethereum was basically nowhere. So it's catching and latching on to these kind of trends, understanding that they are important, or assessing whether they're important. Having the vision, having the plan put in place, and having the follow through. Because once you have it, it's good. It doesn't change. There are changes at the edges to make it sharper, to make it better as we go along, but not wholesale changes. I mean, I just give you one example, which is very frustrating to me for many years: the use of English. I remember there was once, and I don't know whether some of you have noticed, and I may be wrong, but I've seen advertisements before in Malaysia which tries to promote the use of Bahasa Malaysia, which I agree, but to the extent of putting down English, and like people were laughing at this person trying to use English and such. Oh, kenapa tak guna Bahasa Melayu or Bahasa Malaysia, and so which is very sad, because now when you look at it, I have companies here, and I speak to companies here in Singapore who are switching over to Malaysia because it's cheaper, because the culture is the same as Singapore, so it's easier to get along with people, but finding it very hard to find staff because the staff cannot speak English, or at least proper English. And we're losing out because of that. So these kind of policies, whether to use English in school, set it, keep it there, and follow up on it. So that's really how you gain your competitiveness over a long period of time, not switching every couple of years because the new government has come in and you want to show that whatever lah, So anyway, I've just went on a long rant. Hand it back to Sinji before I add on.
But yes, it has been an amazing session as usual, Mr. Sani. Yeah, thank you so much for joining tonight. Haikal, welcome back. Really love to have you up in this space more if we can. But unfortunately, our time has run short. Okay, guys, and do check out our Twitter profile. We have a lot of things going on, a lot of upcoming events also. And consider subscribing to our Patreon membership for those of you guys who are interested. All right, guys, good night. See you guys soon. Bye.
Thank you for everybody.